So I'd like to thank the Central Illinois rental property professionals for having me speak about taxes and growing your wealth, or also known affectionately as reducing the tax bite on your wealth. My name is Peter James Newman Jr. I just turned 50 years old and I was born in South Orange, New Jersey. My grandfather, Frank Newman, pictured here on the left, passed away when my dad was 11. He left a single mother, my grandmother Adele, with 5 kids, a house, and no money. My grandmother was a devout Catholic. She worked in the Catholic school cafeteria across the street as a lunch lady, and she raised 5 children as a single parent. My grandfather was a plumber, and my great-grandfather was a plumber, and my father went into the Air Force when he was about 18, met my mom, served in Vietnam, and then he went back to New Jersey and became a plumber. So I come from a long family of plumbers. This is my father's business card from when I was 8 years old, and I keep it to remind me of several things. One is be humble and hustle. My father's business went bankrupt, which is why when I was 8 years old, we had to sell everything and move to Georgia. 2, put a little money away for the future. Having seen my parents struggle financially, that's where my interest in financial planning came from. And 3, the third thing this card reminds me of is that failure is not an option. Despite the fact that my father's business failed and my parents were boom bust, and I actually moved 25 times by the time I was 23 years old, I give my folks a lot of credit for my brother and I not being out on the street homeless. When I was 16, in one of our many moves, we actually wound up in Maryland. And the real reason we moved around so much is my parents were never good with their finances. And my dad would make a lot of money and then spend it and not be able to hang on to it, and something would happen and we'd have to move and start over. But even though that was the case, my father was able to teach me some really good lessons. The car on the upper right was my very first vehicle, a 1967 Ford Mustang, which I absolutely loved. I worked construction during high school as a laborer and drywall taper for several summers to pay for it. My friend on the lower right was my best friend Kevin in high school, who worked on cars with me. Well, we moved around some more. I eventually wound up going to college in New York City and also at Rutgers State University in New Jersey. I graduated from Rutgers in 1993. My choices of graduation, I'd worked actually I'd even worked construction during college as a plumber myself. So my choices at graduation were start my own plumbing company in New Jersey, but there was a big recession going on. Second option, I had got a marketing degree, was go to work for a paltry sum of money in New York City advertising world and live with 5 other people in a cramped apartment in New York City, which didn't seem very appealing. My third option that actually surfaced was to move to Champaign-Urbana for graduate school. In August 1993, I moved to CU for grad school. I thought I'd move to CU, give it a try, and if I didn't like it, I'd just move back to the East Coast a year later. The photo on the left is from Gregory Hall. It's my cohort in grad school from August of '93. On the right is me a couple of years later on the phone with a law firm in Washington, D.C. I was very fortunate to meet a marketing professor, and we formed a marketing consulting and product liability company. And the purpose of that company was to work on all of the trials in the 1990s related to the tobacco industry. I worked on almost every one of those trials. And I used some of that money from that business to later invest in real estate. But wanting some stability, probably because of my childhood, shaped my career aspirations as well as my risk-taking views as an adult. I'm actually a very calculated and careful risk taker. I always wanted to have some steady income, even though I was an entrepreneur. I was very fortunate to be hired in 2000 at the University of Illinois while I was finishing my PhD because of my entrepreneurial background. They wanted someone to come in and work on ID card and small dollar cash programs for the Springfield campus. I was very fortunate to have a good mentor, and I worked my way up to the age of 34, where I took over managing all of the banking, borrowing, and investments for the University of Illinois system, Chicago, Urbana-Champaign, Springfield, and the hospital. I spent 20 years doing that until I retired last summer. If you've been in a building at the University of Illinois, my team probably financed it or managed the investments that pays its bills. Because of my construction background and having saved some money, I got interested in real estate investing. I had a business partner for a number of years in Champaign. We owned a property management business, duplexes, and small apartment buildings. My main role in the business was dealing with the banks and overseeing some HR issues, but Marcus ran our construction crews and our maintenance division. I actually got a little burned out on real estate in 2008, 2009, having done it since I was about 26, and I was kind of looking to pivot to something else, so I sold off my properties in the business. I started Peak Wealth Planning in 2014. The why of my business is that it's really important to balance living fully today with planning and saving for your future or your legacy. And I like to think of this both in terms of health as well as wealth. So my goal is to help others along their journey to take care of their families with good financial planning, investment management, life insurance, or whatever means is most appropriate. So a quick disclaimer, I'm sharing information today in a general sense about taxes, investing, growing your wealth. Seek professional advice from your tax advisor or your financial advisor unique to your specific situation. We do have a blog, peakwealthplanning.com blog. I publish an article every week on different topics. If you want some general advice, you can check that out. So the specific topics today, I was planning to give a very brief history of federal taxes, talk about tax brackets and tax rates today, give you some questions to consider in terms of taxes, as well as wealth building, illuminate a little bit how tax deferral works, and then I'm going to talk about some of the typical investment vehicles we see folks taking advantage of for saving for the future, and also talk a little bit about the tax implications of each of those vehicles. Then I'm going to move on and try to provide you with some vignettes or wealth building ideas that either you can apply or you can share with someone else. And at the end, I'll mention some resources that we have available after in case you want some more information. So how should we think about taxes? And Kim's been gracious enough to load in some polling questions. So Kim, could you please put the first polling question up? Do you believe US federal tax brackets will be lower or higher in the future? So 79% believe that tax brackets will be higher in the future. So the second question is, do you believe that the taxes you pay or your personal tax rate will be lower or higher in the future? What you actually pay as a percentage of your income. 87% of folks think that their taxes will be higher in the future. So I'm going to talk a little bit about that and how you might manage that later in our presentation. And then can you please put up the third polling question, Kim?
Yep.
So is it more important to you to pay less tax today, meaning when you file your taxes for 2020, or is it more important to reduce taxes across your lifetime? This is really illuminating for me. It's nice to see that 87% are more interested in reducing taxes across your lifetime rather than necessarily paying less tax today. And we can talk a little bit about that as we move into some of the vehicles. But sometimes our behavioral instinct is to pay less tax today, even if we may pay more tax later. It's sometimes a little bit hard to say, well, can I lower across my life, even if I actually have to pay a little bit more tax today? So it's interesting to see these polling results. So thank you everyone for participating. So marginal income tax rates, and marginal rate is the highest rate, or the marginal means as your income goes up, you might pay more tax, or then there's brackets. But the marginal income tax rates, at least the highest ones, have varied greatly across time. And our US income tax system was enacted in 1913. And early on, very early on, only really high income individuals had to pay tax. The graph on the left side, the bar graph, shows the highest marginal rates from 1940 to 1920. And what the exact numbers are not as important as, but if you look from 1940 to 1980, rates were generally double, at least the highest rates were generally double what they are in the most recent from 1990 through 2020. So really, in the last 30 years, rates are actually low, at least for highest earning individuals in comparison. And I also put up, because I know most of your real estate investors are involved in real estate, on the right-hand side, just a quick synopsis of some highlights of capital gains tax from different years. But you'll notice 1950 capital gains is 25%, 1975, 35%, but most recently in 2021, 20%. And for most taxpayers, even in 2021, you're probably in the 15% capital gain bracket. If you're a single individual, you have to be over 445,000 to pay 20% capital gain, and over 501,000 if you're married and filed jointly to pay 20% capital gain. If I have my numbers wrong, forgive me. That was the research that I found when I was putting this together. This data changes periodically. I also thought it would be useful to just show, because I don't know how many folks look at this super close. I'm sure some of you do. I thought it was interesting to put up the chart of the expected 2021 marginal tax rates that we will be paying. And as an example, if you look on the left-hand side, it's the federal tax brackets. And if the second column, it says single. And the way this chart works is if you look down to single where it says $86,400, I did this in 3 zeros. If you earn whatever dollar you earn above 86,400, so let's say you earn $90,000, the dollars you earn between 86,400 and 90,000 are taxed at 20%. The dollars you earn between roughly $40,000 and $86,000 are taxed at 22%, and the dollars you earn between roughly $10,000 and $40,000 are taxed at 12%. So the important thing to understand here is that the last dollar you earn is the highest tax you pay. That's the point of sort of illuminating these marginal tax rates. And as a result of our polling, we can see that many folks are concerned, especially in light of the federal debt that's been taken on recently, that we may see an increase in marginal rates and potential capital gains taxes in the future. And I'm guilty of this, what I'm about to say, but I often hear folks talking about the top tax rate or their marginal rate, but not necessarily taking a look at a number that I think might be more meaningful, and that is your effective tax rate. And the effective tax rate is the actual amount of federal income tax you pay divided by your taxable income. So for an example is, if you're a single individual, and after you take some deductions on your tax return, you've made $100,000, your last dollar earned is taxed at 22 cents on the dollar. But maybe you only pay the federal government, $18,000. So your effective tax rate is actually lower, 18%. That's your blended rate. You basically have all your income, you paid about 18% in taxes. So I think there's 6 questions to think about, and I'm not expecting each one of these questions to resonate with everyone here, but I just wanted to mention some questions for you to think about as we move forward in this presentation. And I realize we have different folks at different stages of their career, but what's your personal wealth building strategy? How do taxes sort of fit in with that? And that refers to our polling question. Do you prefer paying tax today or in the future? If your sole focus is lowering tax each year, what's your strategy to cover taxes later? And then which different investment vehicles, aside from real estate, can you use to defer or accelerate your lifetime tax payments? And I know several of you own businesses or work at companies, but a good question to ask is, how do I retain employees with retirement benefits? And then for some of you that may be in the fortunate position that may owe estate taxes, is if you think you might owe estate taxes, will I owe them, and how will I deal with the state taxes? So I want to give a little explanation. For some of you, this is old hat for you. For some of you, it may be new information or just a refresher. But I want to speak just briefly about how tax deferral works. So if you receive income, you can lower your wages that you report to the IRS by making what is known as a tax deductible contribution. And that tax deductible contribution, we typically see folks making those to a 401k or an individual retirement account. And I'll talk about those accounts in a second. But the investment earnings, as well as your contributions to a traditional 401k or a traditional IRA, are not taxed until you take retirement withdrawals. And usually those withdrawals start after age 59 and a half. But the important thing to remember here is, even though you're deferring the tax, you're not avoiding it. It's not tax-free. So you're simply delaying the tax due. There's nothing wrong with that. It's just important to recognize that. So I thought it'd be good to give a couple of examples. Here's my single individual. She makes $86,000. This is the box, the first box up here on the upper left. She reports that to the IRS. Interestingly, her top last dollar earned is taxed at 22%. That's her federal tax bracket, but her effective tax rate is 13.9%. And her net pay after tax, or her take-home pay, is $63,000. And I put in the FICA and state tax since we're in Illinois, just to make this a little bit more real. But what's interesting is this individual can, if her workplace offers a 401k, could potentially put $1,000 a month into her 401k if she can afford it. And then she can drop her federal effective tax from 13.9% to 10.9%. So you're paying about 3% less tax today. And what that effectively does is it adds a few $1,000s, $12,000 to her 401k. But if you look at sort of net pay, knowing you have to pay tax on some of the money later, her net pay is about $3,200 higher if you take into account the tax deferral and what goes into that 401k. So if you're looking at that person's balance sheet or the scorecard of their wealth, they actually have a few $1,000s more by virtue of making that 401k contribution. And then I thought I'd give another example because many folks are married. This is a higher income couple, married, $212,000 in gross earnings. And in this instance, the effective federal tax is 15.6%, net pay after tax $157,000. So this couple, they're super savers. They each decide to put $19,000 a year into their 401k. But interestingly, they can lower their effective tax bracket by almost 4%, pretty significant. And they increase their balance sheet by about $10,000, assuming they saved all their income. Well, at least by what's in the 401k and the tax benefit thereof, by about $10,000 by making the 401k contribution. So that's above what they would have been able to otherwise. So that's nice to see. So is tax deferral all good? It really depends. Tax deferral, or putting money in a traditional IRA or 401k, is really most beneficial if you invest for a couple of decades or more. And it works best if your marginal, best meaning pay lower lifetime taxes. It works the best if your marginal and effective tax rates, which we covered earlier, are lower when you retire, when you draw retirement income, than when you deferred the income. That doesn't mean if you think rates are going to be higher, you shouldn't necessarily do it. But I've seen tax deferral used for other strategies as well, in addition to saving for retirement, which is perhaps you have a really high income and you're trying to get below $250,000 on what you report to the IRS. You might make a large 401k contribution or an IRA contribution to get below $250,000. Why would you want to get below $250,000? There's a 3.8% surtax on investment income that's in place today. Or many of you are real estate investors. There's some different thresholds where you can get some special loss allowances on rental real estate, but you have to have an adjusted gross income. I believe it's below 100,000. There was a couple other thresholds. I didn't dive super into deep in them, but you can manage what you report to the IRS with some tax deferral. And sometimes there are strategies that make sense to do that in addition to the long-term benefit of saving. So There's a number of different accounts that quite honestly are confusing for a lot of us that you can save and invest for the future. And what my goal here is not to make everyone an expert, but it's to hit the highlights of the more common ones I see being used by individuals as well as local businesses. So I'd like to start with the ones available to you as an individual. And these can be set up on your own without intervention or help by your employer. So there's an individual retirement accounts. They can be opened by you. And there's two types. There's a traditional IRA. That's the one where you can have the tax deferral. And there's a Roth IRA. With both of these accounts, you can contribute up to $6,000 a year or $7,000 a year if you're of mature age and over 50. And the traditional IRA provides the tax deferral that was covered earlier. And at retirement, you pay taxes on withdrawals with the traditional IRA, as we covered before. With the Roth IRA, you earn your income, you pay tax on your income, and then you make an after-tax contribution. The key benefit there is both your contribution and the earnings on your account or what's in your Roth grow tax-free. And at the time of withdrawal, generally there's some exceptions, but beginning age 59 and a half, you won't owe any federal tax. And the state of Illinois doesn't tax retirement income either, so you won't owe Illinois tax on that either. So Roth IRAs are quite nice for individuals who believe their tax brackets will be higher in the future. So my kind of general advice to folks is, if you know, particularly a younger person, if they've already built up some emergency savings, maybe encourage them to consider putting some money into a Roth IRA. The next account I want to talk about is what's known as a brokerage account or a taxable brokerage account. And typically when folks think about investing, this is the account that often comes to mind. And an individual can open a brokerage account. You make after-tax contributions to that brokerage account, but there's no limits on contributions. You can put as much money as you want in there. The pro and con of the brokerage account is there's limitless investment options, but some of those investments have tax drag or will have tax due each year. You might owe some tax on the earnings in that account each year. But there's investments such as municipal bond funds or some exchange traded funds that are very tax efficient that can reduce or lower the tax bill on what's in your brokerage account each year. You can also manage that tax bill by managing the timing of selling a stock that you own or selling a bond that you own. But I generally recommend that folks that want to build liquidity on their balance sheet use a taxable brokerage account once you've set aside emergency savings and you've set aside the money you need to operate your real estate and do capital repairs and that sort of thing. Now, what's in that brokerage account is a different story. You might not be super aggressive if you're going to use that money in a few years. If you're putting that money in a brokerage account and you're not going to touch it for 30 years, you might be a lot more aggressive. And by aggressive, I mean more stock investing, less bond investing. Let's shift gears. Maybe you own a small property management business or a large property management business, and you have looked at different retirement account plans. I actually talked to someone yesterday that owns a business, and they were a little bit confused about all these different plans. So I want to just hit the highlights of some of the plans we see out there. The first one is called a simple individual retirement account. And it's called an individual retirement account, but it's actually funded by both the individual and the employer. And this offers tax deferred retirement savings. And one of the benefits is there's higher contribution levels that you can do each year than with an IRA, so you can save more. Employees can contribute up to $13,500 of their salary, and companies must make a contribution if you have a simple IRA. It's required every year. They can either contribute 2% of every employee's salary across the whole employee base, or they must match the first 3% of employee contributions. Simple IRAs actually have a pretty low administrative burden. And what I mean by that is they don't require a separate IRS tax filing by the employer. And they can actually be a good option for an employer with up to 100 employees that doesn't have another retirement plan. The next type of tax deferred account that I often see is what's called a simplified employee pension, or a SEP. And this is funded solely by the company without employee contributions. the company can contribute between 0 and 25% of all employee wages up to a maximum of $58,000 per employee. Now the employee has to have wages high enough so that 25% equals 58,000. But let's say an employee made $100,000 and the company said, we're going to give 25% of all wages into the SEP. Well, that the employee making 100,000 would get $25,000. One of the benefits of a SEP is that it provides companies flexibility to contribute in years when profits are good. But if you have a lousy year, you don't have a required obligation to contribute to the SEP. So you can reduce contributions or go to 0 if profits are down. SEPs are nice because they don't require a separate IRS filing, and they're actually pretty simple to administer. They're also a good option for closely held profitable companies where owners have significant stakes and similar compensation levels. They're used in other areas, but I often see them in closely held companies with 2 or 3 partners that are trying to save a lot of money for retirement. So the other account, which you're probably familiar with, is a 401k. And those are employer-sponsored retirement plans. Employees can contribute up to $19,500 to a tax-deferred or a Roth 401k. There's starting to be Roth 401ks that come out. And employers will typically make matching contributions in 401ks. 401ks do require an annual tax filing, and they're more administratively burdensome than a simpler SEP for that reason. But 401ks are a nice option for employers that wish to retain a large employee base and reward their employees. You may or may not be aware of this, but there's a law passed where the state wanted to encourage retirement savings options. So if your company has more than 25 workers and do not have another retirement plan like one of the ones we covered, you have to offer the Illinois Secure Choice Roth IRA. And the Roth IRA, the employee, in this case, in this secure choice, the employee is defaulted to putting away 5% of his or her payroll each year up to the $6,000 Roth limit. So this came out a few years ago. So you may have heard folks in the last few years talking about this. They had to set this up for their employees, but the companies aren't having to put cash in. It's coming out of the employee paychecks, but defaulted at 5%. The employee can opt out, but this was to help with some of the lack of retirement savings in the state of Illinois. So an Illinois Secure Choice Roth IRA can be a quite good option for an employer who doesn't have a budget for matching and wants to keep things simple.
Peter?
Yes.
Which of those, I expect it's the first 3 that you can control where the money is being invested, because that's going to become more important as we go forward. Can you comment any on that?
Absolutely. Generally, 401k sponsors the company-sponsored vehicles, Simple, SEP, and 401k. The Simple and the 401k generally will limit the investment options. The SEP and the taxable account, taxable brokerage account, and the individual retirement account generally will not limit the investment options. So the employer-sponsored accounts, they will limit them in the sense that they try to put some guardrails around what you as the employee can invest in. But you have the most flexibility and the most choice in a taxable brokerage account or an individual retirement account. So that's an excellent question, and thank you for pointing that out.
So if you are also the employer as well as the employee, which some of our members are, then you as employer have a few more options, right?
The employer would have options of choice among these plans, yes. If I don't, or you're talking about investment vehicles.
Yes.
Yeah, when they typically when folks are consulted on or consulted with on setting up a 401k or a Simple, they will, whoever's helping set that up will say, here's the vehicles we recommend you offer to your employee base. What's interesting is a SEP can be set up, and the SEP account can be set up to where it can be, held with like a TD Ameritrade or Charles Schwab, and you can have limitless choices. So the SEP is, even though it's employer sponsored and employer set up, it actually has the choice of any bond, stock, mutual fund, exchange traded fund. But you are right, Andrew. There's more decisions to be made by the employer when they set up some of these plans, and choices they have to make. And there's actually a fiduciary responsibility that goes along with those choices, meaning you probably can't set up a 401k fund and say the only thing you can invest in as an employee is gold. You have to provide, as a fiduciary, you have to provide a range of options that's reasonable for folks to save for the future and invest.
And is diversified.
Yes, they have to. There is a fiduciary responsibility to do that, but there is a there's a lot of guidelines out there on what is best practice, and most of the 401k plans I've seen follow that. So there's actually been a lot of lawsuits around 401ks in the last, particularly the last 10 or 15 years, but I don't want to go too far into that right now. If someone wants to have a conversation on that as a sidebar, I'm happy to do it.
Thank you, Peter.
So we've covered a lot of different retirement savings vehicles, and after the presentation, I'll send you a link where you can get a checklist, because this is confusing, but it'll help you decide which of these plans might make most sense for you as an individual or if you're a business owner. But now I just want to kind of hit upon some different practical strategies. But before I do that, I have a couple of additional polling questions. Kim, I was hoping you could help me with those, please. So the first polling question is, do you believe you will owe estate taxes? So we had about 44% that said yes, they think they'll own some form of estate tax. So that definitely creates a planning opportunity. Unsure was 22% and no was 33%. So it's pretty even, not exactly even, but a good distribution of folks that fall into the different camps on estate taxes. And of course, the thing to consider there is that federal estate tax versus state tax, state of Illinois estate tax, because there are different rates, and I'll talk about that later in the presentation. The second polling question, Kim, please, if you could put that up. I actually call it number 5. And this question, do you use a health savings account to pay your medical expenses? So we have about a third, 31%, that use HSAs to pay medical expenses, and 69% do not. And I'm actually in the camp where I just changed. When I was at the university, I didn't use an HSA. Since I've left the university, I'm using an HSA, and I'll talk more about HSAs in a minute for folks that are not familiar with them. And then the third polling question, or number 6, please, Kim. And the question is, have you ever done a Roth IRA conversion? So we have about 27% that have say yes, they've done a Roth conversion, and 2/3 have said no, they have not. And this doesn't surprise me because this stuff is complicated. 7% said they're not sure if they've done one, and that's a very fair answer. Maybe your accountant said, hey, you should do this because it makes sense. You didn't 100% understand, exactly what it was. And honestly, that's part of my conversation today, is to help educate folks so that next time you hear some of this terminology, it makes more sense, or you can tell your friends and neighbors about how to utilize it best for their situation. So and some of these you may have heard, some of these may be germane to your situation, some may not. So, pay attention to the ones that make sense for you. But one of the pieces of advice I give folks that have closely held family businesses is transfer wealth to the next generation by putting your children on payroll. It teaches responsibility, work ethic, and can get them started saving early in life. I did some calcs. If you pay your teenage daughter $12,000 a year, she will owe 0 federal and state tax, at least according to Tax Act. If you pay your son $24,000 a year, his effective federal tax rate is actually 5%. So think about how that might compare to yours as a parent. If you want to push the wealth building further, you could let him or her spend half the money and save $6,000 a year in a Roth IRA. Tell them I'm a believer in Roth IRAs. In 50 years, your child will have $2.4 million if they max out the Roth IRA. Actually, if they just put $6,000 a year in it every year. That sounds like a long time, but saving, the earlier you start, the better off you are. But $2.4 million at age 66 is a pretty good amount of money. The second suggestion I had, and this relates to what we've already covered some, that create a strong foundation and reward your employees. For many of you, your employees are the lifeblood of your operation. And I'm going to talk about something that you may not have thought of. If you have salary workers or hourly workers, I suggest that you consider as a company policy matching a savings account or a credit union contribution, maybe $25 each paycheck. Maybe you're paying people every 2 weeks. And why would I suggest that as a financial advisor or retirement planner or wealth building? Well, that helps employees build up cash reserves. So when their car breaks down or their kid needs braces or their laundry machine breaks, they don't raid their retirement account. And they're a little bit less stressed because they have a bumper cushion of savings, and they might be a happier employee if they have less financial stress in their life. So encouraging some savings in a regular savings account or a credit union account is not a bad idea for employers.
And they may show up to work when their car breaks down because they have the money to pay for the repair.
Absolutely.
So it can benefit you as well.
Absolutely. Lower stress, better employee attendance. That's absolutely correct. Beyond that, consider perhaps the Secure Choice Roth IRA if you want the employees to fund it themselves, or some of these other plans if you want the employer to participate in funding retirement. And that, some of these choices depend on your employee base's propensity to save, how much turnover you have, as well as the employer's willingness to make contributions. But taken in combination or standalone, each one of these programs or vehicles can be used to reward and retain good employees. The next item I just want to talk about is like a general concept to think about. And for many of you with real estate investing, maybe this is less of an issue. But one of the biggest challenges I've learned kind of working in wealth management now since 2014 is for folks who are investing, particularly in the stock market, whether it's a brokerage account or an IRA or a 401k, it's sometimes hard to have the discipline to keep investing. But if you forecast the growth of that account based on some regular contributions, and there's a zillion online calculators you can use this to calculate this, but you can plug in the goal you want to hit and see what the goal is, and it will tell you how much you have to save to hit that. And I think sometimes forecasting and knowing where we're going or what the goal is can make it easier to set that money aside for the future. And since this is a real estate group, and I was in this very position, when I was younger, if you know a real estate investor trying to get started and they've got, maybe it's a 2-income couple and they're being a little bit careful with their money, perhaps recommend to them the bucketing concept. Put $300 to $500 a month towards emergency savings every month, put $300 or $500 a month towards a Roth IRA. You've paid the tax once, maybe while you're younger, your tax bill's not as high each year, but maybe you're going to make more money later. So you've paid the tax once and you're done with the Roth IRA. And then whatever you have left over, maybe it's $1,000 a month, maybe it's $500, maybe it's $100. Put that money towards the real estate down payment for that first duplex or that small apartment building. The idea here is by bucketing, you can keep sufficient cash on hand for lean times, but also meet some of your goals. So it might take you 36 months to get enough money for the down payment for real estate. In your Roth IRA, you might be saving across a lifetime. And in your cash reserves or savings, you might decide, hey, after we hit X dollars in that, we don't have to keep allocating money towards that. And you can reward yourself and take yourself out to dinner or something fun like that, or take a trip to Southern Illinois to see Garden of the Gods. So I like to put this up. This is a forecasting example To have $1 million at age 65, you need to invest $820 a month starting at age 35. If you were to wait until you're age 55, you actually need to invest $5,778 each month. So this is really to illuminate, and this is a 7% return compounded across time, the benefits, whether you're, and of course, subject to cash flow, but if you can start investing early, whether you're investing in real estate or in the stock and bond market, starting earlier works better than starting later. If you're in the fortunate position where you've got significant idle cash on your balance sheet, you can invest that efficiently tax-wise in a brokerage account. And I mentioned earlier, you can use some municipal bonds and dividend-paying stocks. This is an actual example from a client of our firm. We invested $1 million for them back in, I think we started in 2016. We had designed this account to earn about 3% a year. This account has actually done a little bit better because there's been so much demand for the municipal bonds during the time of this account. But the benefit of an account like this is it had very low tax bill each year. And also, talking like maybe a few hundred to $1,000 a year on this level of investment. The other thing we've seen is we'll see investors set some money aside like this, and then they'll pledge it against a line of credit to do real estate deals, but they'll keep this in place. So this will be a fairly low risk account that won't move around a ton in value, it'll move around some, but you can pledge it and then recycle the money, much like you would on a HELOC or some other type of loan against real estate. From our polling earlier, most investors believe tax rates will be higher in the future. Consider working with your CPA or financial advisor to diversify your tax situation. So if you're working, get a free match from your 401k, use the Roth IRA if you can, max that out each year if you can, put excess cash in a brokerage account, and take your obvious real estate write-offs, which most of you are well versed in. So, having a mix of tax deferred, tax-free, Roth, and taxable accounts can help you with some diversification. So when you get to retirement, you don't have I doubt this would be the case for most real estate investors, but you don't necessarily want all your money in tax deferred accounts at retirement. If you put some money in Roth earlier, you've diversified when you're paying your tax bill. So we saw before that I think it was 1/3 of folks use a health savings account. So I'll talk a little bit about that. If you have a health insurance plan where you have a high deductible, and many of us do, either ask your employer or consider setting up a health savings account on your own. You can contribute $3,600 a year if you're single, or $7,200 a year for a family. You get a tax deduction for the contribution. Any earnings are tax-free, and withdrawals for qualified medical expenses are tax-free. This is absolutely the most tax-efficient investment you can make, maybe except for investing in real estate. So after my presentation, we'll send an email. You'll have a checklist to determine whether you can set up an HSA or use one. If you're in the fortunate position where you have good cash flow and you've saved significant wealth for retirement, and maybe you're 10 years or 5 years out from retirement, and you've got a lot of money in a traditional IRA or a traditional 401k, consider doing Roth conversions in the next 3, 5, 10 years, even this year. Why? Most of us from our polling thought tax rates were going to go up. Take advantage of the low brackets today, pay the tax on the conversions, come up with a plan over 5 or 7 or 8 or 9 years or 3 years to convert a big chunk of your money that's tax deferred to Roth. You'll benefit yourself in retirement, and you may actually benefit your heirs as well too. Before, we saw in the polling questions that I believe it was 44% thought they might owe some estate tax. If your net worth exceeds $4 million in Illinois, you'll owe some Illinois estate tax. If you're single, federal estate tax exemption is $11.7 million. These amounts are doubled if you're married. Last time I checked, Illinois estate taxes were running around 16%. Federal estate tax rates were 40%. So one way you can lower your estate taxes is to remove assets from your balance sheet. This can be done by gifting money to family members each year. You can do $15,000 per person. Actually, you can gift to anyone you want. Most people gift to family members. You can also set up irrevocable trust and transfer assets to trusts. You're not getting out of paying estate tax on what moves into the trust, but the growth of what's in an irrevocable trust is exempt from estate tax. If you think you'll owe estate tax and all your assets are tied up in real estate, you may want to take a look at your balance sheet and work with your financial advisor, CPA, estate planning attorney and say, hey, where's the liquidity or cash going to come from to pay the tax on this estate? I've seen this with farm families where they'll have lots of money tied up in farmland, but not much cash to pay in a large estate tax bill. There's some insurance strategies you can use, or you can build cash in a brokerage account to pay estate tax. The insurance strategy is an ILIT, a life insurance trust, and that's a more complicated discussion than today, but suffice it to say, you can fully pay up an insurance policy and use that to pay your estate tax bill. So after our presentation, we're going to send out an email that has some different resources, checklists and flowcharts, so you can see which accounts you can save more in if you're interested. You can figure out if a Roth conversion makes sense for you, and you can look at the health savings account and decide if you can make a deductible contribution. I'm really grateful for your attendance, and I'm really pleased to share this information so you can continue to grow your wealth, invest in real estate, and moderate your tax liability. You can, when we send out the email, we have a monthly newsletter you can sign up for. We won't bombard you with information, but we do try to put out useful information from time to time.